Well, we have seen the crude oil prices trade in the positive, and there are macro as well as individual fundamentals supporting that. We have seen the Chinese factory activity come in positive on a month-on-month basis, and this is a sixth straight month that you are looking at a positive number there. And stimulus measures, even if not in totality, we are looking at focus within some sectors, and that markets also are looking at in positive. You also have more than 90% of oil and gas facilities in Gulf of Mexico shut ahead of the Hurricane Delta, which makes landfall today. So that's bothering. This is the sixth time in this season that you have seen Gulf of Mexico go down for a shutdown because of the hurricanes there. And then the Norway output also is a bit of a concern. You had statements from OPEC saying that they are looking at demand recovery, the worst is behind, and that they would continue to work up to ensure that there is a global balance for demand and supply. So there have been various reasons for the crude oil prices to trade above $40 for both of those varieties. But from here on, what are we to watch? For that, we have Peter McGuire joining in the conversation. Peter, hi. How are you looking at, first of all, the OPEC statements itself, because that is what would drive the markets for a longer term. How have you read into that?
Well, good afternoon, Manisha. Yeah, I read into them all right, but then again, I look over to Europe and we've got a big concentration of clients in Europe, and we're very worried about those numbers coming into France, Spain, UK. Numbers we've never even experienced in April or May as far as COVID infections, Manisha. So I look here on the 9th of October and I say, where are we going to be, God help us all, by the 9th of November, let alone December or January in the depths of a very cold winter? So I don't agree with the demand destruction saying we're seeing, green shoots everywhere. I think we're going deeper into further demand destruction. And I think it's going to be a very, very tough 3 to 4 months ahead of us.
So what's your sense on where the prices could be moving then? Because right now, yes, it is about supply concerns as well. But having said that, we are more than 200 million barrels above the 5-year average as we stand. So yes, you're right. The supplies are still higher. The inventories are still building up, and there is demand destruction.
Well, I can't see any true breakout above 45 to the upside and below, say, 38 for Brent and WTI until we see something as far as conviction from a market-making movement. It's either President Trump, it's either China, it's either something going on with Taiwan, it's either an election that the Constitution, they say we're not moving out. Something dramatic has to happen to really create turmoil for the markets to go, I think, a lot higher or a lot lower. So I think it's going to remain range-bound. I still see that US dollar at the moment at that 93.5. So I don't see any great movement there either, Manisha. So maybe we're going to see a sell-off as far as US equities. We're in October, I should say. That could be the month like it always does. It's a volatile month.
There are also various reports on how various asset classes or commodities behave due to the run-up to the presidential elections, during that, and a month or a year after that. So while, of course, we do see metals, whether it's precious metals or base metals, tend to gain, tangible commodities tend to see some buying ahead of the presidential elections, not so much for the crude oil prices. They actually are usually subdued, and they continue to be like that even after the presidential elections, is how the reports have been suggesting for the last 25 to 35 years. How do you look at this time? Because it's not just about the US presidential elections, it also is about COVID and demand destruction. So is that going to be yet another reason to push prices down?
Well, I think so. I really, and I agree with what you've said there. And, the data going back all those many years, this time round, though, we do have further on the counter argument is one of the worst hurricane seasons, and we're still, a couple of months until the end of it. We've got Delta creating mayhem in that shutdown of the Gulf of Mexico. We understand China's roared back with industrial demand, and their equity markets today were very, very strong. So that could be a little bit of a counterbalance. But the other side, of course, is what happens as far as those booming COVID numbers, and that could really cause, a cratering effect. So I think that there's more chance of being bearish than bullish in the short term leading up until, say, the end of November, Manisha.
That's about the crude oil prices, but the other commodities seem to be doing well, especially the precious metal prices. So gold is back above 1900, For this week, we have seen the silver prices gain up by nearly 5% as well. We are back around those $24 per ounce kind of levels. Would you see the strength in gold continue until the presidential elections, until the end of this year? Any numbers, ranges that you're looking at here too?
Well, first off, we're up $20 today, Manisha, and we've still got, what have we got? We've got the best part of 12 hours until New York shuts tonight. So I feel as though I wouldn't be surprised to take, with some conviction, you might take 1920, 1922 out. The issue, quite simply, is that if this equity market does have some sort of correction between now and the 3rd of November, gold's very well positioned to have a big run up from here, and I think I wouldn't be surprised to put by month's end, maybe another $10 to $30 on it. I wouldn't be surprised at a 1950 handle, because I feel as though it's more in an uptrend than a downtrend. US dollars a little bit choppy, but gold's been oversold, and now it's having a rebound to the upside. So I think as though gold's not a bad place to be in the short to medium term leading up until the end of the year, Manisha.